Hey, this is Stu with the Military Investor Network, and today I wanted to go over some ROI calculations that I've seen on some different turnkey real estate offerings. I've gotten on quite a few lists of different turnkey companies, and I get emails with their latest deals. And so I've seen a bunch of different pro formas on how to calculate the ROI. And I kind of wanted to just go over some things that I've noticed over the past year or so as I've really gotten more into learning how to calculate ROIs and the differences. So I'm going to kind of show some stuff that I look for, and I'm not saying that any of these are right or wrong. But what I am just wanting to show is where you might look at some differences at how different companies calculate stuff. So I'm just going to start out here with this one right here, and this is a Memphis property, and I'm not going to say who the company is who's making the offerings on the turnkey products, but here's their calculation. This is a bigger pockets rental analysis, which I really do like because it kind of really breaks down everything. But let's just go through this real fast, and you'll kind of see some stuff that I saw. So it's a $67,000 purchase and $750 of monthly income. So it definitely beats the 1% rule, which is good. And they're saying that it's a 19.68 cash-on-cash return, which to me seems really high. And we'll kind of dig into it a little bit. But first thing I noticed is that the loan interest rate they're using is 5%. And if you one thing you want to make sure you know is kind of what the average interest rate is at the time that these are being calculated. I can tell you right now, and this was just offered to me recently, I would assume, and I make a bet, that it would be really hard to get a 5% interest loan. It's probably going to be more like 5.5 or even 5.75, or depending on your credit score, maybe even 6 on an investment property. Normally it's about at least a point higher than the standard interest rate that you would get on a mortgage. So, and that's for an investment property. So 5% to me seems really low. I would say it's going to be more like 5.5 or 5.75%. Next thing I saw was the vacancy rate and the repairs, $22.50 a month. And so if you take $22.50 a month and divide that by 750, you get like 3%. So the calculation for vacancy and repairs is 3%. Now again, I'm not saying it's wrong, but 3% vacancy is like way less than a month of a property being vacant. So is it realistic to say that if you have a tenant move out, you're going to get another, you're going to get the property, fixed up, painted, new floors, whatever that may be, cleaned up, marketed, advertised, and back on the market, and a renter in place in less than 30 days? I normally don't see that. So again, not right, not wrong, but something to think about as far as your vacancy and repairs. Also, I noticed on this one that there's no capex. There's no savings for the big repairs that could come down the road, like putting on a roof or putting on a new HVAC. So if you come down here and you're looking, if you're having a total annual cash flow of $3,000 a year, but they didn't update the roof when they rehabbed the property, and you have to put a new roof on in year 2, and that's going to cost you, $6,000 or $10,000. Well, then you are totally in the negative by year 2 or year 3 because you didn't calculate any type of capex into your calculations. So this one, this 19.68 cash-on-cash return, I don't think that's realistic. and something just to think about. So that was the property number 1 that I looked at. Here's property number 2 that I received just recently. It is in a different location. I think this one's in Birmingham, Alabama. And again, a different spreadsheet, but you got to look at the numbers pretty closely here. And it's really clean, and it breaks it all down, which is nice. But this one's $86,900 purchase price, and the rent is $885 a month, so barely meeting the 1% rule, which is fine. But again, what I noticed here, if you kind of go down here, they did an interest rate of 5.5%, which is better, quite a bit more realistic. But again, one thing I noticed over here was the vacancy loss is, let's see, if you do $44 divided by 885 equals 0.5, so that's 5%. So that's a little better for your vacancy. And then your maintenance is $42, insurance, management fees, taxes. But again, what they left out was CapEx. And a lot of turnkey companies will tell you, if you ask them the question of why you're not including CapEx in their pro forma, they're going to tell you that, well, it was recently rehabbed, so everything is new and nothing's going to break, and so we don't need to calculate in the CapEx. And I think that's kind of not the best answer, because 10 years down the road, you are going to have to put something into it. Something will break, I promise you, if you hold on to the properties long enough, which is the idea and the goal for turnkey buy and hold rental properties is to hold forever. You're going to have to put a new roof on. You're going to have to change out the HVAC. It's going to happen, so you might as well plan for it from day one. So again, they're not saving for any type of capital expenditures in their calculations for the pro forma. So if you include that, let's just say you include another 5%, $42, this net cash flow monthly goes down to $140 a month. And $140 a month, so $140 a month times 12 equals $1,680. So that's $1,680 of annual cash flow. And then if you divide that by your total cash invested initially, which is over here of $22,594, that equals 0.7, so 7% cash on cash return instead of the 9.7% cash on cash return. So again, not right, not wrong, just making everyone aware of how different pro formas are advertised. Go to another one here, and this one, I think the biggest thing that I noticed on this one, this is a property, I think it's in Kansas City, but this one, larger purchase price of basically $130,000, and I think this one said the monthly income is $1195, so it doesn't meet the 1% rule, which doesn't excite me. But maybe it's in a nicer area, and maybe you're going to get a B, B or A type tenant instead of a C or D. But the biggest thing I noticed on this one is the closing costs of $1,500. To me, from my experience, the closing costs, if you're using a lender, your closing costs are going to, all included in is probably going to be more like 3 to 4% of your closing costs, and then especially also if you're paying any type of realtor fee. So $1,500, if you do that math, 1,500 divided by 129,950 equals 0.011, so 1% of the purchase price. So that closing cost seems really low to me. Now, maybe this company has a title company, and maybe they use all their internal lending, and maybe they give a discount. So I'm not discrediting it and not saying it's true, but this is something that I would question right away, is why they say the closing costs are so low. And closing costs are included in your total cash needed, which then also allows you to calculate your cash on cash return. So if you have a low closing cost calculation, it's going to be lower total cash needed, which boosts up your cash on cash return on a pro forma. So just something to note there. Again, I saw the interest rate of 5.25, probably not realistic for right now. There's probably going to be a higher interest rate than 5.25. What I did like about this one is all of the expenses were calculated. A lot of times, like I said earlier, the CapEx is left out, but the CapEx is actually calculated here, and the vacancy rate is a little more realistic. 7% is closer to that 30-day of being vacant, and that's a little more realistic than what I use for my calculation is 7% vacancy. And they had a 5% CapEx, 8% management, property taxes, repairs of 5%, insurance of 4%, and then their principal and interest payment on their mortgage. So the expenses, all the expenses are calculated here, which I like. But what I didn't like was the low closing costs. And then one more I'm going to show right here is an Excel spreadsheet, and it's very busy and there's a lot of stuff here. But one thing that some companies will do is try to use loan principal pay down as a part of their advertising ROI, and not a bad concept, but if they're saying in their advertising that it's a 17% ROI on year one, and they're using the loan principal pay down into their calculation, again, not false advertising, but just a different way to advertise the ROI and not the true cash on cash return. So one thing I noticed on this one is their cash on cash return. They're doing the annual cash flow. They do all the expenses here. They do vacancy of 5%, and then they do the miscellaneous expenses is what they're saying is their repairs and their CapEx. So it's a little low if you are combining the repairs and CapEx. $780 a month is right at about I guess 10% of the gross rent in a year. So actually that's probably about right. So 5% each of expenses of maintenance and of CapEx. But again, one thing I did notice on this one is they are including the down payment as their total cost invested, but what they're not including is any of the closing costs into their cash invested. So if you add an additional, let's just call it 3%, 3% of 61,000 is $1,830. So another $1,800 plus your $12,200 equals $14,000. So really your total cash out of pocket is $14,000, not $12,000. And then if you go down and do your cash on cash calculation right down here, if you had a annual cash flow of $1,471 and divide that by 14,000, your cash on cash is actually going to be 10% instead of 12%. So again, just know what you're looking at, know how they're calculating their pro formas, and make decisions on your own on how best to calculate that pro forma. Make sure that they're including all of the costs associated into their expenses and into their initial cash out of pocket, and understand how those calculations are being done. This is the form that I use, and I try to break it out really easily. I do like the bigger pockets rental analysis because it does the same thing. It gives you a very good snapshot in percentages. But I am including the closing costs of, I do 4%. That's probably a little on the high side, but I like to be conservative. And then I use an interest rate of 6% on our calculations. And then I make sure I break it out of mortgage, principal, and interest, taxes, insurance, and I like to get actual quotes from companies for insurance. Maintenance, I do 5%, or depending on the house size, maybe just like $500. If it's a real small house, I do $500 a month. Oh, I'm sorry, $500 a year, and then capital expenditure is $500. We currently have property management at 9%, and I do vacancy at 7%. And so it shows and breaks down all those calculations of your expenses and your calculations of your total purchase cost, and then you can break down the different types of ROIs. You have the cash-on-cash return, and you'll also have a ROI based on your leverage, which is always going to be higher than your cash-on-cash. So again, not right, not wrong, different ways to look at pro formas and your calculations on your return on investment. I hope you like that. Please like it on YouTube. Please share it. If you have questions, you can go to militaryinvestornetwork.com and post a question in our discussion forum. And please spread the word to other military and veteran investors. Thanks.